Hello, I'm John Ward on behalf of Physical Gold Fund and Anglo Far East. We're delighted as always to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. He's the author of the New York Times bestseller, Currency Wars, The Making of the Next Global Crisis. And most recently, Jim is the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Hello, Jim, and welcome.
Thank you, John. Great to be with you again.
Jim, in our recent conversations, you've been consistently downbeat about the state of the US economy. Right now, as I'm looking at my news feeds, it seems everyone is saying happy days are here again, particularly with regards to job growth. How should I understand the discrepancy between your outlook and the media consensus?
Well, there are probably a couple things to bear in mind. First of all, John, you're exactly right in how you framed the question. My analysis and some others is much more negative, or at least reserved on growth in the U.S. economy versus what you do read in, say, the mainstream press and certainly here on much of financial television. And there are a couple of reasons for that. One, a lot of what you see on financial TV is populated by sell-side analysts. So these are people, they're the good people, but, they're working for Goldman Sachs or Morgan Stanley or JP Morgan or one of the wirehouses, or they're working for issuers of securities. They're sort of corporate spokespeople. And, of course, they have a big vested interest in selling you stuff and making you think it's all going to go up. So there is a little bit of let's call it a cheerleading effect that goes on. I think most investors and listeners are alert to that, but I wouldn't underestimate the power of it. So there's a lot of people with a vested interest in the happy talk. But beyond that, there are, serious economists and mainstream analysts who are very buoyant, if you will, about the last employment report. A fair number of jobs were created in September, and some of the prior months were revised upwards. But you have to peel behind the numbers a little bit. You can't stick with the headlines. And the thing that struck me, jumped right out at me, was the decline in labor force participation. Just when you think it can't get any worse. So just for the listeners, the labor force participation is not the same as the unemployment rate. It's basically a very simple fraction. How many people are in the able to work, kind of working age, and how many of them are actually working. It's as simple as that. And that number has been going down and down and down. It's now at the all-time low. In other words, they haven't kept these records forever. The records go back to the 70s, but you have to go back to, I think, 1978 at this point to find a lower labor force participation. That's around the time when women started entering the workforce in much larger numbers. And so the labor force participation went up, and now it's all the way back to where we were in the 1970s. So when you think about the fact that, what is an economy? The economy is really just how many people are working, so that's sort of the labor input, and how productive are they, and that's sort of the capital or technology input. And that's it. Who's working and how productive are they? Well, if fewer people are working, then obviously your output is going to be lower unless your productivity is going up. But actually, the recent productivity figures show it's going down. So we're going down on both vectors. The number of people working and the productivity of those who are working are both going down. That's a major drag on the economy, in addition to a lot of other structural impediments, things that are standing in the way of the U.S. achieving its potential growth. So that's one. Also, if you look at real wages, and the best advice I give anyone trying to understand the economy, if you want to know what Janet Yellen is looking at, if you want to stare right at Janet Yellen's dashboard, it's real wages, because real wages are where labor force and inflation or price stability come together. Now, let's go back to the Fed's dual mandate. The Fed has a statutory dual mandate. You can argue about whether it's sensible or whether it's even achievable. In my view, it is not. But that is what the law says, and that's what guides the Fed and Janet Yellen in particular. So their dual mandate is price stability. That means, in theory, no inflation, no deflation, just stable prices, and also reducing unemployment or maximizing employment in the economy. So that's the dual mandate. Well, sometimes those things are at odds. Sometimes the thing you need to do to get inflation under control might actually cause unemployment to go up. But today we're in the opposite situation, which is to say, Yellen is concerned primarily with getting more people back to work, increasing that labor force participation we just talked about. And she's not worried about inflation for the time being, because none of the inflation signals are blinking red. So how do you reconcile these two things? How does price stability and maximum employment where do they come together? Well, the answer is real wages. These are inflation-adjusted wages. And basically, you look at how much wages are going up, and then you subtract the inflation component, and that's the real wage. Real wages are flat to down. They've actually been negative in some recent readings. And in Yellen's mind, when she sees real wages going up, that will be her inflation signal. That will tell her, because what it means is that people can get a raise. If you go into your boss today and ask for a raise, you'll probably get thrown out of his office, if not fired. People aren't getting raises by and large. Some people are in some sectors, but across the board, no. And so, but if I can go into my boss and get a raise, that's a sign that I've got some bargaining power, that if I don't get the raise, I might quit my job and go work somewhere else, or there's a new, company opening up across the street and they've got a for hire sign out and so forth. So real wages are a sign that labor has bargaining power. And once they get the wages, they'll start to spend the money. And then that's a signal that velocity will increase, inflation will take off. And then those are signs that Yellen needs to tell her that she might need to raise rates. Well, guess what? Right now, those signs are not flashing red. They're actually, they look like there's no inflation in the system at all. So she's trying to create jobs by printing money. She's not worried about inflation. She's not seeing real wages go up on her dashboard. That means her inclination or her default position would be to print more money. Now, I understand that right now we're in tapering mode, but as we've said before in prior interviews, tapering was a blunder. The Fed tapered into weakness. The weakness is starting to show up. You're seeing it in stock market action. You're seeing it in corporate earnings. You're seeing it in a variety of indices. So my expectation is, they will finish the taper. They're locked into that. They've only got 1 month to go. Why not get it behind them? But my expectation is that there will be no rate increases in 2015 because the economy is doing very poorly. They may even go to QE4. It's hard to say that hard and fast, but it would not surprise me at all to see them go to QE4 and actually increase asset purchases by, say, March or June of next year. So happy days, unfortunately, are not here again. Labor force participation is declining. The jobs that are being created, many of them are part-time jobs, not the kind of jobs that really are going to provide income as necessary to stimulate consumption. Inflation is more like deflation than inflation at the moment. And so the economy looks very, very weak.
Let me ask you a little bit about economic information sources. There are those who argue that government statistics are themselves manipulated, for example, the CPI. And I'm thinking of websites like Shadow Stats, which contends that inflation is far higher than official reports. What's your take on this?
Well, I'm familiar with Shadow Stats, and I do look at it, and I do think that's very valuable information. I actually don't need Shadow Stats. I just talk to my 83-year-old mother who tells me about the price of milk at the counter, or the price of gasoline, or heating oil, or some of the things that she pays for. So I've got my own built-in inflation gauge. And look, I think it is true that for things that Americans buy over the counter day to day, actual inflation is significantly higher than the CPI series that the Consumer Price Index series that the U.S. government puts out. So I'm willing to take this as given, but let's step back from that a little bit and talk about what we mean by manipulation. If by manipulation we mean that there's actual fraud, that people sitting inside government offices are getting data and then they're manipulating the data or lying about the data or putting out numbers that are just not true, I would be I don't believe that's happening. I would be shocked to discover that's true. However, having said that, there's a lot of gray in these government statistics, and you have to sort of work in these agencies or be a trained economist to understand kind of what goes on behind the curtains. There's a lot of room for maneuver that's not outright fraud or outright lying, but it does involve subjectivity and judgments, seasonal adjustments, estimates. When these numbers come out, they're aggregated from reports that are coming in from all over the country. Some of these are samples, meaning they don't get the data from everyone possibly affected. They get it from a subset or a sample that they take. Some of them are estimates, so they've got some of the data, not all of it, and they use that part to estimate what's missing. Some of them are seasonal adjustments, but, because of a variety of factors, demographics, climate, weather, et cetera, some of the seasonal adjustments may be out of date. So there's lots of wiggle room now. So if you said, at the margin, would a highly politicized administration try to fade the numbers a little bit? That could be. That's different from outright lying, but it's a kind of political manipulation, if you will. So there's probably a little bit of that going on, but I think less than some of the critics might imagine. Beyond that, there are, over the decades, there have been changes in the methodology. Now, these are announced. They're debated beforehand. Some people still debate them. They call them, one of them are hedonic hedonic adjustments. Hedonic just refers to the quality of the goods. So you can't take an automobile from 1979 and line it up next to an automobile from, say, 2009 and just say, well, okay, they've both got engines, 4 doors, 4 tires, a glass windshield. So let's just look at the price. The hedonic adjustment would say that, well, you're getting more for your money. The 2009 car is, safer. It's got anti-lock brakes. It's got airbags. It's got, a lot of other features, Sirius XM radio, you name it. So it's not enough to just say 2 cars have 4 wheels and let's look at the price. You've got to say, well, you're getting more for your money. Well, that tends to be deflationary. So that's one thing. But obviously, I just described how it's done. In theory, there's a lot of subjectivity there. So between the seasonal adjustments, the hedonic adjustments, the estimates, and all the, let's call it the gray, there's plenty of room to fade these numbers a little bit. And some of it's not, deep, dark, black helicopter conspiracy stuff. It's just, people doing the best they can and maybe using flawed methodology. So there's lots and lots of room. I think what Shadow Stats does is extremely valuable. But here's where I come out on this, John. It sort of doesn't matter. When I say it doesn't matter what I think. What matters is what Janet Yellen thinks. I mean, I have opinions on all this, and people who do Shadow Stats have opinions, and any listener can follow whatever series they want and draw their own conclusions about what's really going on, and that's fine. It's one of the great things about the digital internet age. We have ample sources of information and competing views. But if you're trying to understand policy, if you're trying to figure out how to invest, if you're trying to figure out how to allocate your portfolio, for better or worse, you have to understand what Janet Yellen is thinking. She may be right. She may be wrong. She may be using flawed models. I think, in fact, she is using flawed models. She may get some bad data. I think that's likely also. But it is what it is. And what I try to do is put aside my own views, my own, I have biases like anyone else, and my own way of understanding how the economy works, at least for the purpose of trying to figure out policy. And to do that, you have to put yourself in Janet Yellen's shoes. And Janet Yellen believes the government statistics. So they may be flawed, they may be gray, they may be at odds with what people encounter when they go to the grocery store. But if that's what Janet Yellen is using as a guide, then you need to look at that number if you want to understand what she's going to do next. And that number, those official numbers, not only show no inflation, lately they're showing deflation, and deflation is a central bank's worst nightmare. So that tells me she's going to print more money, and that's why I say I wouldn't be surprised to see QE4 next year. So, kudos to the people at Shadow Stats. I think it is important stuff, but I don't put too much weight on it only because I'm trying to figure out what Janet Yellen's thinking, and if you want to do that, you have to look at the official statistics.
Well, let me now turn briefly to the world situation, Jim. This morning, as we're recording this, it seems that political unrest in Hong Kong may not be over. Given the status of Hong Kong as a financial center, how significant is this story looking forward?
Well, I think it's very significant, John, and you've actually touched on one of my, I'll call it a pet peeve lately, which I've referred to in other interviews as the curse of the 2-second attention span. And what I mean by that, yes, we do live in a digital world, digital media and the internet, and I think it's great. I think it's fantastic that people have so many sources of information. But part of what comes out of this is every story just kind of comes and goes. We wake up and we want our digital fix, if we will. We want our new story, and we forget about the old stories. And we forget about the fact that these things have not gone away. And, there are many examples of it, but just go back to earlier this year, February, March, we had the so-called Maidan Square riots in Kiev in Ukraine, which were protests against the government. Markets got a little jittery. The government was overthrown, but Putin reacted by invading Crimea, and markets sort of went down on that news. But then, a couple of days later, like, well, okay, Putin got Crimea. We're not going to do anything about it, at least not militarily. People start rationalizing. And then just everything went back to normal, as if, too bad for the Crimeans, but that story is over. Well, it wasn't over. It was never going to be over. Then it got into Ukraine and the shooting down of the Malaysian airliner, and then the Kiev forces went on the advance, and then Putin moved in, supplied the Ukrainian rebels, and then there was more fighting, and now it looks like a fait accompli that Putin has in effect peeled off to eastern Ukrainian republics, and it's still not over. So I'm always surprised at how people think that these stories last for 1 or 2 days as if it were, a car crash or something. And in fact, they don't go away. So the same thing with the Islamic State, the same thing with the Iranian nuclear program. And I think the same thing with Hong Kong. These stories, they may seem to come out of nowhere to people who are not, experts in those particular areas. But we tend to dismiss them after a day or two. And I just keep piling them up and saying, well, none of them are going away. All of them are coming back. So and any investor who is surprised when these things reemerge or is surprised that they get worse shouldn't be, because they're not really paying attention to the dynamics behind them. So I think the Hong Kong story is a very big story. I think it's not going away. I think we're going to be hearing more about it. But let's sort of maybe look at it from Beijing's perspective, because the reporting, it's not inaccurate, but the reporting is this is a pro-democracy demonstration. Beijing is getting very heavy-handed with the voting or electoral situation. Hong Kong is saying, yeah, you guys can have an election, but you can only vote for people that we approve of. And guess what? All three candidates are henchmen or minions, and so it's really not much of a choice. It's sort of a sham democracy, and people realize that, and they're protesting against that. But from Beijing's point of view, they have no tolerance for any protest. It doesn't matter if it's a democracy movement in Hong Kong, if it's the Falun Gong movement in China, if it's the Catholic bishops, at least the ones that the Vatican approves of, not the sort of communist approved Catholic Church, if it's the Uyghur separatists in Western China, if it's people protesting about being pushed off their land. I expect we'll see money riots in the near future when people realize that the Ponzi scheme of wealth management products has collapsed and their savings have been wiped out. Any kind of protest or instability is taken with a great concern by Beijing. And this is because China has a history of collapse. I call it the accordion theory. The state power is concentrated, then it collapses and it falls apart and it expands into all the regions and the districts. Then over a long period of time, it's concentrated again and then it falls apart again. I mean, this is the history of Chinese governance and government and empire and dynasty for the past 4,000 years. And the history is that it can fall apart very quickly and very unexpectedly. The paradigmatic case is the Taiping Rebellion, which lasted from 1850 to the 1860s. It lasted over 10 years. This was a guy who failed an entrance exam to the civil service, the Mandarin, so to speak, and failed it a couple times and realized he wasn't going to get a job. He wasn't going to get the job he aspired to. Went to bed, had a dream that he was the brother of Jesus Christ, woke up, told a friend, and the two of them started the Heavenly Kingdom movement. Taiping in Chinese means a heavenly kingdom. Well, within a year, they had 100 million followers. They had taken over half the Qing dynasty, set up a capital in Nanjing, and were attacking Shanghai. The whole empire had fallen apart. This is within a year based on two guys. One guy had a dream, right? So the Qing dynasty forces combined with foreign forces, German, Japanese, really imperialist troops, they put down the rebellion. There were 20 million casualties. Historians aren't quite sure. Well, that, 1850 sounds like a long time ago, but not to the leadership in Beijing. They are a centralized dynasty. They are a communist dynasty following on the Qing and the Ming and the Song and Tang and other famous Chinese dynasties. It's just a communist dynasty, highly concentrated, highly vulnerable. And they have zero tolerance for any kind of shocks like this because they know how quickly things can fall apart. So that's how they look at it. That's how they looked at Tiananmen Square, which, by the way, was not just this is 1989, where no one knows the exact number, but some historians estimate thousands were killed by People's Liberation Army troops that kind of came in and just shut it down and killed people trying to escape and killed people in the square. And that, of course, has been covered up ever since. So we look at the Hong Kong demonstrations as, you got some students and some younger people and some others who are a little upset about how the elections are going to go. But Beijing looks at them as a potential Taiping rebellion, something that could spread to the mainland. I talked to one of the top Chinese princelings. Princelings is a sort of a shorthand for the elites and the oligarchs who are descendants, second or third generation descendants of people who were on the Long March with Mao Zedong. And one of them told me that the greatest fear of the leadership in Beijing is not the U.S. Navy. It's Twitter mobile apps, because mobile apps are harder to interdict than the internet because they operate through self systems rather than hard lines and internet backbone, and people can communicate very readily and spread information. So they're very fearful of this.
Well, Jim, talking of stories that won't go away, you've repeatedly warned us of the real threat from hackers, especially not exclusively emanating from Russia. And since we last spoke, there have been reports of massive hacking intrusions affecting around 12 major US financial institutions. I just wondered if you had any comment on that.
Sure, and you're right, John. When we saw events in Crimea and later Ukraine starting last winter, I wrote an op-ed on the topic of financial warfare, and I said, look, clearly the U.S. was not going to intervene militarily, at least not in a kinetic way, but our response would be economic sanctions. But I was warning the White House that if they pushed those too far, Russia would push back asymmetrically, meaning they would do things that were not strictly military, but could be damaging to the U.S. And in effect, we were back to the Cold War of escalation and mutual assured destruction, and I actually called it mutual assured financial destruction. Well, since then, I think Russia has behaved in exactly the way I expected. So we put on, economic sanctions on their oligarchs, and we prevent some of their major corporations from raising debt in European markets and U.S. markets. We closed off the capital markets a little bit. And Russia, there's a lot they can do. They could sell U.S. assets and raise U.S. interest rates, et cetera. But it seems that they're operating in the cyber warfare space. By the way, in late July, there was a cover story in Bloomberg Business Week. I recommend it to the listeners. It's easy to find online, about the NASDAQ hack, where the FBI, Department of Homeland Security, found a Russian attack virus inside the operating system of the NASDAQ stock exchange, one that was capable of completely shutting down the exchange. And by the way, that's not inference. That was an exact quote from a U.S. government official. And this virus came not from some criminal gang, but from the Russian government. So they're entirely capable of this. I said so at the time, and we're seeing more and more evidence of it. Now, interestingly, the most recent story, of course, we see a massive intrusion into J.P. Morgan systems and other large banks and financial institutions, apparently coming from Russia. And what's interesting is they don't seem to be, the usual intrusion is, I'm trying to steal a credit card number or a social security number so I can do identity theft and, online fraud and all that. But this doesn't seem to have been that type of attack. It's much more planting viruses and getting ready to disrupt or take down the financial system, or perhaps a warning shot. In the old days, two naval vessels confronting each other. If you didn't want to sink the other guy right away, you'd fire a shot across the bow. That was the expression to show that you were capable of sinking him and try to get him to be on his best behavior. Well, I think this looks to me like a shot across the bow. Putin letting the attack be discovered as a way of saying, look what I can do, don't mess with me, very much Putin's style. And interestingly, the New York Times reported the other day that as this was being monitored over the summer, it was just revealed really in the past few days, but it was taking place last summer, known to the intelligence community and to the White House. But the question the president kept asking is this Putin's revenge? He wasn't thinking of it as in financial space. He was thinking of it in military and geopolitical space as a form of cyber financial warfare. I think that is the right way to think about it. I think it's a good question. I think it's pretty clear that this is Putin sending a message to the U.S. Look, if you want to keep putting on sanctions on our energy companies and our banks, be my guest, but don't be surprised if you wake up one day and your stock exchanges are closed. And by the way, there are real examples of this. I gave one as reported by Bloomberg about this attack virus. But remember, August 22nd, 2013, the NASDAQ stock exchange was closed for half a day. It shut down around noon and didn't reopen for hours. And everyone kept saying, why won't they tell us what's wrong? Why won't they tell us what's wrong? If what was wrong was some kind of computer glitch, they would have told us. They would have said, it's a computer problem. Some engineer was loading some software and did it the wrong way, and we're really sorry, it won't happen again. The fact that they haven't told us, the fact that they've never offered a public explanation suggests to me that the real explanation is one that they don't want people to know about, which is that it was some kind of cyber attack. Because if people realize that, they'd start pulling some of their money out of the stock exchange and getting it into hard assets such as gold or land or fine art or things that are not digital, things that cannot be erased by Putin's hacker. I think this is a very serious threat. I think we're seeing Putin fire shots across the bow. I think we're seeing Putin demonstrate what he's capable of. And I think the U.S. is getting the message, which is one reason why the sanctions won't go much further, because of the threat of retaliation, which means that Putin keeps eastern Ukraine and Crimea. So it's something that starts out in traditional geopolitical space, but today plays out asymmetrically in cyber financial warfare, and it's the new world we live in. But again, I call it mutual assured financial destruction, as if investors didn't have enough to worry about. Here's one more thing. But to me, it's an argument for not keeping all of your wealth in digital form, but keeping some of it in physical form, including gold, precious metals, land, fine art, and other tangibles.
Well, let me turn to a gold question here, and it's on a global level to begin with. You've talked to us before about what you called the rebalancing of sovereign gold stocks with really a concerted shift of gold from west to east, and specifically to China. And as I understand it, a shift that's implicitly endorsed by the United States. We received a question by email from Lawrence Rodriguez, which reads as follows. But what is the actual end game? Jim gets us to the point where China and the US have equal amounts of gold. But what happens then? Is that when the US, China, and IMF countries and the other G20 agree on a gold-backed trade settlement standard, or what? What is the final state of currencies?
Well, it's a good question, and this is something that I cover in chapters 9 and chapter 11 of my new book, The Death of Money. But, the process is the one you described, John, and we've talked about it before about, it's very widely vetted. Gold is moving from west to east. Gold is moving from, central bank warehouses in the West and in Europe and in the GLD warehouse in London to Chinese warehouses in Shanghai. And that movement and the acquisition of gold by China is very well documented. What's interesting is I've seen some figures recently that the cost of gold mining, Chinese production inside China, is now approaching $2,000 an ounce, which of course is way above the current market price of about $1,200 an ounce. What that tells me is that the Chinese are running out of gold. In other words, the quality of the ore is deteriorating. The degree of difficulty of finding it, mining it, is getting harder and harder. The fact that they're still doing it tells you that they're price insensitive. In other words, they want the gold. They actually don't care about the price. By the way, the Chinese use horrendous mining techniques. You use cyanide to get gold. You get the ore and you mill it, you grind it, and then you sort of leach out the gold using cyanide. Well, if you're a Canadian or a U.S. company, you've got to account for every drop of cyanide. You have to cache it and store it and then measure it before, measure it after, prove that you did not, kind of let any cyanide go into the environment. Even though you're using it. Well, that's not true in China. They just dump it in the rivers and poison their own people. They don't care. But the fact that their costs are so high tells me they're running out of gold. And I said that some years ago because China was, they were sort of back in the pack producing, 90 tons a year. The big five are producing about 200 tons a year. And they came from back in the pack to, 450 tons a year, way out in front, twice as large as the next largest producer. In a couple of years, they did it, almost seemingly overnight. But then people were extrapolating that far into the future. And I said, well, no, what's going to happen is they're going to have a couple of good years in terms of acquisition of gold, but then those mines are going to be depleted and they're not going to find any more. And that appears to be what's happening. They've stripped the mines bare so that 450 tons a year that they've been banging out for the past 4 or 5 years, it looks like that's coming to an end. And then that just makes the supply side even tighter. So that's what's going on. Now, what's the end game? What happens when China reevaluates or reannounces its goal? We all know that they have thousands of tons more than they've announced publicly. And one of the questions is, well, when will they update their figures and admit to the fact that they actually have 3,000 or 4,000 tons as opposed to the official 1,000 tons that they say they have? And it's hard to know. I mean, I've estimated sometime maybe in the middle of 2015, but that's an estimate. It could be sooner, it could be later. And but I have revised my target upwards. I had China trying to acquire, perhaps 4,000 or 5,000 tons so that their gold to GDP ratio would equal the United States. But the problem with that is their GDP is rising faster than the U.S., so it's a moving target. So even when you hit the target, you've got to buy more gold because you're growing faster than the other guy. And if you want to maintain that gold to GDP ratio, you have to keep piling on the gold. It may be the case, in my latest thinking, based on some reports coming out of China and some research, is that they may just be going for the 8,000 tons. Just forget about the gold to GDP ratio. Let's just have more than the United States as a way of declaring that they're a larger economy and a larger financial power, et cetera. Whether they're targeting 4,000 tons, 5,000 tons, or 8,000 tons, it's still the case that they've got to acquire all the gold they can. So the question is, what happens when they get there? What happens when they announce it? What happens when we live in a world where Chinese gold and U.S. gold are equilibrated by whatever measure you want to use? Well, the answer is inflation, because to understand why that's what this is leading up to, you have to go back to really the beginnings of Bretton Woods in the 1950s. In 1950, the United States had 20,000 tons of gold. By 1970, the United States was down to 9,000 tons. Well, where did the 11,000 tons go? Well, it went to the U.S. trading partners of the time. It went to Germany, France, Italy. They all got 2,000 or 3,000 tons each. Netherlands, Japan, others got something in the hundreds of tons. But if you add it all up, that was where the 11,000 tons went. And that was because in those days, up until 1971, if you traded with the United States and you ran a surplus, you had dollars in your reserves, you could cash the dollars in and get gold. And they did to a very great extent. And they acquired all that gold. Now, flash forward 30 years or 40 years. Now, China's the big trading power. China's the big country running the surpluses. But they never got the gold. I mean, Nixon entered that in 1971. So all the Chinese could do was get dollars. Now, they could buy treasuries, they could buy stocks, they could buy land in the U.S., they could do a lot of things with it. But what they couldn't do is get gold from the U.S. at a fixed price, which our trading partners in the 60s were able to do. So China was feeling, wait a second, this system is rigged against us. Back in the day, trading partners of the U.S. could get gold. Now we can't get the gold. But China said, well, we're going to get it anyway. We're just going to buy it on the market. And the reason is that they're extremely vulnerable to inflation. If you have $4 trillion of reserves, which the Chinese do, and say $3 trillion of that is denominated in U.S. dollars, which it is, then all the U.S. has to do to get out from under that debt is to have inflation, in effect, devalue the dollar. Every time you have 10% inflation, it's like a $300 billion wealth transfer from China to the United States. In other words, people say, well, China has us over a barrel because we owe them $3 trillion. Well, no, they don't. We have them over a barrel because we owe them $3 trillion, because we can just print the money, hand it to them and say, hey, China, here's your $3 trillion back. Good luck buying a loaf of bread because it's not worth anything. So, it's like the oldest joke in banking is if I owe you $1 million, I have a problem. But if I owe you $1 billion, you have a problem because you have to collect the money from me and I might not pay you. And so when we owe China $3 trillion, they have a problem because we'll give them the money, but like I say, it might not be worth very much. So they're extremely vulnerable to inflation. So what they're doing is piling up gold as a hedge. They can't dump the treasuries. I mean, the market's big, but it's not that big. And the U.S. could stop them in various ways. So they can't dump the treasuries. They can't get out from under the paper side of the equation. But what they can do is pile up enormous amounts of gold. Then they're insulated. Then they're hedged. So if the dollar is stable, maybe the gold won't do very much, but they'll collect the real value of the dollars. But if we inflate the dollars, which is much more likely, they will lose on the paper side, but they'll make it up on the gold side, on the physical gold side. Now, the U.S. is okay with this. The U.S. is counting on China for a lot of things. We need help in, there are confrontations with Japan, confrontations in the South China Sea. We need them to hang on to their dollars and not dump the dollars. We need them to buy more treasuries. So given all that background, all the things we need China for, we're always badgering them about, currency wars and currency manipulation, all that. So our quid pro quo is to say to China, okay, we understand. We understand that you're worried about the dollar, you're vulnerable to the dollar, and all of the other trading partners have big piles of gold, and you don't. So we're going to acquiesce or cooperate even in allowing you to get the gold. So this is the gold rebalancing. But what it means is that if inflation took off before China had the gold, China would lose because they would lose more on the paper than they'd be making on the gold. But if they get enough gold, they're hedged because then if the inflation takes off, Yes, they're losing on the paper side, but they're making it up on the gold side, as is the United States and Europe, for that matter. Europe has more gold than the United States. They have 10,000 tons combined compared to the U.S. 8,000 tons. So the rebalancing is the green light for inflation. The inflation probably won't take off until the rebalancing is done. But once the rebalancing is done, inflation, you can just say let it rip, because now the Chinese are on the bus. See, the Chinese are concerned that, the Europeans are on the bus, the U.S. is on the bus, but China's off the bus. But when China gets enough gold, suddenly they'll be on the bus. So all the major powers can let the inflation rip, basically steal from their own citizens who are holding paper assets, and they're the ones sitting on all the gold, 10,000 tons in Europe, 8,000 tons in the U.S., let's say 8,000 tons in China. So they're protected. So that's what's going on. So if you say, what's the end game? Once China gets enough gold, that's a green light for inflation. That's how this will end up.
Well, Jim, may I finish with a somewhat philosophical question? In your 2 books and your many interviews, you've been describing a global monetary system that is heading for collapse. And stepping back, what is the underlying cause? Was it really avoidable? I mean, banks will be banks. Or if I can take a leaf from Thomas Piketty's book, are we simply seeing what happens when market forces are let loose on the world?
Well, it's a very good question, John. And I like to put it in analytical and scientific space. And what I mean by that is I have come out in my books and in public speaking and interviews with some fairly dire forecasts. By the way, people tend to think I must, live in a cave surrounded by machine guns and canned goods, which is not true. I live in a very nice house with a very attractive view of Long Island Sound, and I wake up every day and I manage a portfolio and I get out and about. So I have a fairly normal life in that respect, and my personality is actually fairly optimistic about things. So I might not be the doom and gloomer people imagine me to be, but I am an analyst and I do have models, and they do predict some fairly dire things, including a collapse of the international monetary system. But I don't think that people are helpless. I don't think we have to be victims. I think we can see it coming and we can do things. There are always things to do for investors. There are always strategies. There are always asset classes. There are always some things you can do to, first of all, survive it and preserve wealth, and then even prosper and gain wealth through the chaos. People like Warren Buffett have done this for decades, and others have as well. And the Chinese are doing it now with their gold acquisitions. My best advice to investors is just get some gold, not too much, sort of 10% of your portfolio. And I'm constantly badgered by people, because we know that gold's been going down. It hit an all-time high in August 2011. It's down from there. And people say, well, Jim, you recommend gold. You're an idiot because can't you see it's coming down and all that. And again, that gets back to this 2-second attention span I talked about earlier. But that's why I recommend 10%. You don't put 100% of your assets in gold. You have a diversified portfolio. Gold's down. I've made very good money in fine art. I've made good money in alternatives and other things. And that's why you have a diversified portfolio. And I also have a large component of cash. A fund I manage has 40% cash. And on days when the stock market is down, 2-3% a day, as we've seen, cash looks like a warm, comfortable blanket because your cash didn't go down on the day the stock market did. So the key is diversification, but gold is an important part of that. But what I like to do is not just say the sky is falling, because there are a lot of people saying that. And I think if that's all you're saying, it's kind of content free. Maybe you're a bit of a scaremonger. I don't think you have much to add to the debate, but I look at it, through the lens of complexity theory. And complexity theory involves inputs and outputs, and the most important metric is scale. What's the scale of the system? That's just a technical word for the size of the system, because the worst thing that can happen in a complex system is an exponential function of scale, meaning that if you double the system, you more than double the risk. If you triple the system, you more than triple the risk, because the function is, as they say, it's a nonlinear exponential function. What we've been doing, of course, is doubling and tripling the system. All the banks that are too big to fail, all the derivatives books today are bigger than they were in 2008 when we had the last financial panic. So this is the equivalent of sending the Army Corps of Engineers out to make the San Andreas Fault bigger. We all know that the San Andreas Fault is an earthquake risk, and that's a pretty bad, earthquakes can happen, but nobody thinks it's a good idea to make the fault line bigger. But that is what we're doing in financial space. We're making the fault line bigger by allowing the banks to get bigger, allowing derivatives books to get bigger, and so on. And so therefore, it doesn't take a lot of analysis to see that the next financial collapse will also be bigger, exponentially bigger than what has come before, because the system within which it takes place has grown enormously. It would be fine if regulators and bankers and policymakers understood this the way I just described it to the listeners, John, but they don't. They're using outdated, flawed equilibrium models. They're using models that involve normally distributed risk. Their whole mental and mathematical toolkit for understanding risk and understanding banking it's worse than obsolete. I mean, it is obsolete, but it's dangerously obsolete because it points you in the wrong direction, which is worse than just sort of being blindfolded. So given the fact that the system is scaled up, given the fact that it's a complex system in which catastrophe, or avalanche as I sometimes call it, gets exponentially bigger, given the fact that we've had 5 years without a panic, 5 years of very low volatility. That's a long stretch as these things go. I mean, these panics happen every, 5, 7, sometimes 10 years. But they're not 20 years apart. Sometimes they're only 4 years apart. So we're sort of overdue in that sense. It doesn't mean it happens like clockwork tomorrow, but it does mean no one should be surprised if it does.
Thank you, Jim Rickards. It's been great having you with us today. And thank you to our listeners. You can follow Jim on Twitter. His handle is @JamesGRickards. And speaking of Twitter, please share your questions for our next podcast. Use the hashtag AskJimRickards, followed by your question. Wherever you post that on Twitter, we'll find your question. We'd love to hear from you. Just a reminder, you can find Jim's new book, The Death of Money, at Amazon or at any good bookstore. Get yourself a copy. It's a great read. So goodbye for now, and we look forward to joining you again soon.